Yeah, hi. Welcome everyone to the Amrit Kal edition of FINtastic Talks. Let me start by wishing you all a very, very happy and a prosperous Holi, the festival of colors. May this Holi bring a lot of joy, good luck, and lot more colors into our life. And I know there's some parts of India which are celebrating Holi today. Some of them will be celebrating Holi tomorrow. But we are generally in a festive mood. And let me thank you for coming to this special edition of Fantastic Talks. The basic purpose of a Fantastic Talk is to add value to your life and help you, make more from your money. And that's the whole aim of Fantastic Talks. And we hope that we are able to continue on that journey. This is a special edition because in this edition I have not called any guest, and I thought I will take this opportunity to do a talk with all of you because I wanted to share my own journey. So a lot of people do ask me, what is Bajaj Capital? What does Bajaj Capital do? So some of you who saw my LinkedIn post on 19th Feb, Bajaj Capital celebrated its 59th foundation year. So let me start with the story of Bajaj Capital. That Bajaj Capital was a company found in 1964, and the mission at that time was to help people create long-term wealth. At that time, the only investment product available in this country was stocks, and people just used to think that trading was the only way to create wealth. Whereas, what my father, the founder of Bajaj Capital, realized that trading is not the answer, but it is the long-term investments. And if you do investments on a long-term basis, so like you have a small case and others, he started this concept of a bag where you would invest in the blue chip stocks on a monthly basis. You would buy one stock each, and the whole concept that time was make your children lakpati. And at the same time, UTI came up, the post office schemes came up, fixed deposits were created by Bajaj Capital Company Fixed Deposits, and then all PSUs and other companies started accepting. Because that time very limited number of banks were available, and the whole the companies didn't get money to grow, the credit wasn't there. And at the same time, the banks had all the power. So my father thought that, can I create an instrument where investors can invest directly with good large corporates where they have a trust in, give them money, get higher interest rates, and at the same time, for companies they have more capital available. So this has journey has worked out great. And then we got into corporate bonds, debentures raising, tax saving instruments, and then we started mutual fund in 1990s. We started life insurance, health insurance, and today we are proud to be one of the largest life insurance and health insurance brokers in the country. We are proud of being a broker. So what does a broker do? Is broker is a person who represents you. So broker doesn't represent an insurance company. Broker represents you, helps you understand your need, and on the basis of your need, we help you find the right product. And that's just the start, because people think insurance is all about buying a product. No, it's all about the claims. So we also make sure that our clients get the claims. We have 100% claim settlement ratio. Yes, there are some claims where which are actually not payable, and there we do educate our clients. Okay, look, this type of a claim is actually not payable, and so we have 100% claim settlement ratio. We fight tooth and nail with the insurance companies for our clients' claims and ensure that they get the claim, and there's somebody fighting for them at the time of their claim. And as we do with everyone, we talk about a little bit of the foundation, the background. So I like to talk about my foundation. So I'm a student from Delhi. I was in DPS RK Puram. So during my first years, I wasn't a great student. So as they say, you must enjoy every part of your life. So I used to enjoy myself. I was into sports, and I would make sure I would make the best of every time. Then by the time I got into 11th, I got serious. I started realizing that you have to be good in your studies. And luckily, I had great teachers who mentored me, helped me. And by the end of class 11th, I was doing quite well in my education. Then I did my graduation from Delhi. I did my post graduation again from Delhi, and then I started work. So when I got into the work, it was already there in my blood, because I didn't realize that, I had actually been reading about investments, thinking about investments. And the father gave me a gift on my 18th birthday, which was an X amount of money. And he said, go choose companies, and these are the basic parameters. Go invest your money. And that made me realize that, I started looking at companies. I started reading Economic Times and other other newspapers, and everything started to make sense for me. I started understanding them. I started enjoying the business news. I started seeing, okay, this is, if I invest in this product, then this is the benefit I'm going to get. So it was a beautiful journey. And we have been lucky to have grown Bajaj Capital to where it is today. It has more than 5,000 people working for it. It has another 15,000 advisors that we provide technology and back and softwares to. And we have more than 41 lakh investors who have invested through Bajaj Capital. If you take it, it's almost 1/6 or 1/7 of India's investing population who has invested through Bajaj Capital. So it's been an amazing, amazing journey. And thanks to all of you for being there. So now coming to today's topic. Today's topic is, Amrit Kal. You heard this terminology used by our respected Prime Minister, which talks about that the best time is yet to come for India. And I truly believe India is moving in the right direction. But when we are moving in a direction, there are also some good things, some bad things. So one of the things that has been done is that life insurance worth above 5 lakh rupees in a year is going to be taxable from 1st April. Now, India had one of the best life insurance industry products, or the life insurance treatments, tax treatments, you can say, where the whole maturity used to be tax free, for if you had more than a 10-time life cover, which was an amazing benefit and feature. But this feature is now being withdrawn for all the high net worth. If you ask me the logic, I don't understand, maybe. But it's because, what it used to do is that it used to force people to invest bigger amounts into life insurance, where which some people who don't know will say was negative. But let me clarify to you, today life insurance has some excellent products, and like any industry, there are good products, there are bad products. So if you go into a good product, life insurance was an amazing tool for the industry to get long-term capital, because insurance companies have very long-term money which they can invest into markets. They can invest into giving loan and credits to the companies, and also building infrastructure. And at the same time, you were always also forced to keep some part of your money and create some part of long-term saving, because today there is so much inducement out there. Buy this phone, do this, but at the end of the year, that phone is not going to have any value. Okay? So, if you buy even the best iPhone, it's not going to have any value in 2 years. So you have consumed or used your money, or you go on a holiday, or you go on a trip. But so you must also have a long-term savings. So it needs to be the right balance. I'm not saying that please save all your money, don't live today. No, that's wrong. You have to live and enjoy your life today. Yet you also have to save, so that every day, every year, you're becoming richer for the future, and you have more money through the power of compounding, that you're able to live a much better life. So how does that happen? Again, this is a very basic financial planning question. कि यार मैं invest करता हूँ, then how do I get richer? Because this is by compounding at a rate higher than inflation. Okay, so if the inflation is 5%, so there is a rule of 72, that you divide 72 by 5. So every 14 years, the cost will double. But if you are able to get 10% on your investment, okay, so then you do 72 divided by 10. It is every 7.2 years, your money is doubling. So now let's play this game that, so if you had 5 lakh today, and you are able to get 10%, it becomes in 14 years, 7 years, it will become 10 lakhs. Then that doubles again in the next 7. So 14 years, it becomes 20 lakhs. Whereas that 5 lakh through inflation would have become 10 lakh rupees. So you have actually become richer because your money has grown at a rate faster than inflation. Okay, so that's the whole key to investing, that whether when you're investing, your money should grow faster than inflation. That is, and there we also have to keep into mind the taxation. Okay, so because tax, we look at, sometimes we look at a gross rate. Look, bank FD is giving me 7%, but 7% pay, you are paying 35% tax. So at the end of the day, you're only getting 4.5% in your pocket. So are you going faster than the inflation, which for this example is 5%? No. So even if you're investing, you're not getting richer. But imagine you're investing in a good mutual fund which is giving you 12%. Okay, even with a 10% tax, it's 10.2%. Then over 15-20 years, you are richer than today than you were there. Same is with the good life insurance plans. Life insurance is not, you cannot compare it to mutual funds or equities because they are much higher risk. It can be compared to debt. So today you have guaranteed return life insurance plans, which are the highest hit by this changes in the tax rules, where above 5 lakh rupees is now going to be, the maturity is going to be taxable. Earlier maturity was tax free and you were getting 6.5 to 7%. So in this example, so the what you were getting 4.5% in your bank FD, you were getting a 7% here, you were getting a guarantee, and you were becoming richer over a period of time. Maybe not as much as the stocks when you are taking higher risk, but then that money can degrow also. You can have years where your money is down by 20-30%, and you have to be able to take that risk. And the best thing to do is to build a portfolio which is a combination of everything. There is no one product which is the best or one product which is right. You need to have combination of all products. So before I get into these long-term insurances that I'm talking to you about, let me look at some questions, and let me try to answer some questions. And if you have any questions, please do put it in the comments. They are visible to me, and I would love to answer all the questions. Okay. So Shailendra has asked me this question, that Shailendra, why should I give my money to some other business to grow? Okay, and this is the Shailendra, you're not a unique person. I did the same thing for a long period of time. My investments outside my own company were very limited. But then what happens is that you can't keep all your eggs in one basket. हमने देखा during pandemic or during 2008 Lehman Brothers crisis or the housing crisis in US, there were a lot of companies, a lot of businesses that went out. And today we are living in a hyper competitive world where it is very easy to set a business, but it's only also very easy for business to go down. So if you keep all your money in one basket, then you don't go richer. So if you look at these old rich people or the rich families, they were investing in their business, they were buying properties, they were buying stocks into other companies. So it is diversification which brings you wealth. So it is very, very important for everybody to have a two versions of themselves. One is like for me, Sanjiv Bajaj as a person who invests in his own business, then a Sanjiv Bajaj family office, which is separate, where I'm keeping some money aside, which I can invest into my business or I can give it to my children for their marriage, for other stuff, and or I can start another business with that. But that, so every person has to be two variant of that. And that your family office needs to be one day big enough to be able to match up to your income from your normal profession. That's the way you can be truly be financial freedom. So we have heard of this term financial freedom. Okay, we want to achieve financial freedom, but people don't know what financial freedom is. Financial freedom is when your passive or your family office income becomes more than your current income, and you are not dependent on your current income for your lifestyle, is when you have a financial freedom. And I hope all of you are able to achieve that financial freedom. That happens to a retiree. That today a retiree is able to save 2.5 crores. He has enough money to be able to live a good life because his liabilities have come down. Then if that is the case, that retiree has achieved a financial freedom. But that will only happen if he has bought a house, he's made the right investment, saved money. Only then he can reach. So I hope I've been able to answer your question, Shalinder. Why is it important to have two versions of yourself, and why is it very important to have a savings? Also, friends, please understand that savings doesn't start with savings, it starts with insurance, because first you have to protect what you have created. Now, this is another thing a lot of people don't realize. They think investing is okay. I start investing, I do an FD, or I do buy a mutual fund is investing. No, first part of investing is buying health insurance, so that you are able to give your best treatment to yourself. Tomorrow there is some financial emergency to you and your family. You should not burn out your investment capital, and it's very cheap. Then the second thing is buying a term insurance to protect your family. Third is buying a protection insurance, and then home insurance, car insurance. So once you have insured and protected your wealth, can you start on the journey of growing your wealth? Okay, so please also keep that in mind. Kavita is asking this question of how is Jeevansathi as for 62-year-old. So Kavita, Jeevansathi is a par plan. Par plan means that the returns are not guaranteed. Today, I'll say there are guaranteed return plans available where the risk is being taken by the shareholders of the insurance company. Okay, so I would rather put my money into a guaranteed return plan than a non-guaranteed return plan like Jeevansathi. Okay, and 62 years old may, again, if Jeevansathi is a dual life cover. Okay, so I would say that if your purpose is life cover, then buy a term insurance. Today, term insurance is available till 65. And today I'm not covering that, but today term insurance is available till the age of 85 and 99. I'll explain to you why is that important. So you must relook at your term insurance and rebuy your term insurance so that your term insurance outlasts you. And people will say, no, my liability nahi hai. Why do I need a term insurance? Because it becomes legacy planning. So let me take an example. Suppose you buy a 5 crore term insurance till the age of 99. Now the chances of a person living up to 99 is only 0.03%. So that means this is a fixed amount of money which is going to go to your children. So when a lot of people today don't spend their money because they want to give money to their children. But if they know that I have 5 crore going to my children, then they can afford to spend their money and live a better life. So, so suppose without this money, that 5 crore they were saving for their children, if they had 40,000 rupees a month, with that 5 crore, they can have 1.5 lakh rupees a month. And you can afford to live a much better life. So by buying a legacy planning product, which are these 99-year products. So Alicia is asking the question, can I get a refund if I cancel my insurance? So Alicia, yes, you can get a refund. Insurance comes with a 45 days of money back guarantee. That within 45 days, it's called the free look period. For any reason, if you are unhappy with your product, you get 100% of your money back. And then within a year, there is an extended free look. If you have a genuine reason, your money will get refunded. But even in most of these guaranteed return plans, since the returns are very high, suppose the PPT is 5 years and you have taken regular income for 12 years or 10 years, and then you want your money back. So most of the companies are more than happy giving the money back, because they don't have to then keep paying you that interest. Let me take an example. LIC ka ek product hota tha, Jeevan Suraksha, which is we used to sell it in a very, very big way. That time log bolte the, yaar, what are you selling? LIC is not good. But that product gave a 12% guaranteed growth and a 12%, 1% per month interest, which is 12% per annum guaranteed interest for the rest of your life. And people say liquidity nahi milegi, ye nahi milega. Okay, so, one of my friends bought a plan for 37,000 rupees a month for 35 years. 37,000 rupees per year, sorry. And he's now going to get a 1 lakh rupees per month pension when he turns to the age of 55. So point is that because money is compounding at 12%. And when I talked about rule of 72 by 12 means that every 6 year money is doubling. So, 100 will become 200, 200 will become 400, 400 will become 800, 800 will become 1600, that will become 3200. Okay, so the higher interest rates, and you can get your money back provided you have bought the right product. Insurance companies will be more than happy to give you a refund. Harish is asking, is life insurance a smart investment? Harish, Now, this is a recorded video, and I know I'm going on record, and I'll say yes, it is a smart investment. People who don't know misguide by saying insurance may is not a smart investment. See, as I said, insurance, like any other industry, has good products, bad products. So, what is a smart investment in life insurance? Smart investment life insurance is term insurance. Smart investment is legacy planning insurance, that is 99-year term, is a smart investment. Term with return of premium is a smart investment. Guaranteed return plans, where you are guaranteed and you know कि मुझे इतना पैसा मिलेगा, are smart investments. ठीक है? So it depends on the product you choose. So please work with a good broker or a good distributor, where who you can question that tomorrow if he is missold, at least you have somebody who you can catch कि मुझे ये क्यों बेचा. Explain it to me. So Rakesh is asking this question, that why should I invest in life insurance when I can put all my funds in mutual funds? राकेश, जैसे मैंने आपको एक्सप्लेन किया कि देखो, you have to diversify, build a basket. You can put all your money in mutual funds, but that's not the best thing to do. If you want to get good returns, now look, you need to have some debt. ठीक है, so debt हमारा होता है पीएफ से, और ईपीएफ, that is also a part of debt. A good life insurance guaranteed return plan, because हमें पता है कि कल अगर suppose interest rates 1-2% आ गए, then even equity returns will come down. ठीक है, so please understand, equity returns are also a factor of the interest rates which are prevailing in the market. ठीक है, like US at one time, if you were getting 5%, 6% in stocks, it was considered to be a great return because you were only getting a 1 or 2% interest rate. ठीक है, so ये नहीं है कि so in mutual funds when the interest rates fall, there may be time where the returns are also lower than today because interest rates are lower, and it's all about being higher than inflation and at what rate the companies are growing. So it's always better to build a basket. So in that, as I've said, the smart life insurances that I've mentioned should be a part of their health insurance has to be a part, and then also do mutual funds. It's very, very important, and there also do an asset allocation. You must have the right amount of flexi cap, small cap, large cap, mid cap. So it's good to do good amount of this thing. So then Shashikant is asking me, what is a basic points to select any health insurance? Shashi, one is that don't buy a life insurance which is small, in the sense that health insurance, today 5 lakhs, 2 lakhs, 3 lakhs is not enough. Treatments have become very expensive. And let me just tell you, between a 10 lakh product and a 1 crore product, the cost difference in premium will only be 10, 15, 20%. So best is that they are, just to go for a sort of insurance analysis. Companies like Bajaj Capital offer it free, where you come in, and the things that you need to keep in mind is that it should not have any sub conditions. Sub limit should not be there. It should be a simple sub. It should give you a no claim bonus. ठीक है? It should give you a top up option. ठीक है? So top up, if it's available from the same company or it's a part of that product, it is good. Okay, and if you are rich enough, then you should buy a international cover for critical illnesses, because even today there are some diseases which cannot be cured in India. And we ourselves had a case where one of our customers who had an international product, we could help him go to Switzerland for a treatment for a cancer, which they were saying would be very difficult to treat in India. So point is that it depends on your availability of cash, and these are not too expensive. You can choose. So these are the things that you have to keep in mind. So guys, now let me get into a little bit on the product, on what is Amrit Kal opportunity that I am talking about, and then I will answer rest of your questions post that. So just give me a minute. I'm just trying to figure out how to. So technical team, can you help me with the presentation for some reason? Yeah. Okay. Sorry, guys. My internet is a bit slow. So we are talking about decoding life insurance. So if we go in so life insurance, tax-free guaranteed return plans, and the impact of the budget. So budget had a lot of good things, but the unfortunate thing in the budget was that above 5 lakh rupees, you cannot have the tax-free benefits, which is quite sad. So let me explain. There are a lot of these questions on this tax-free benefits being taken away. One is that this is only applicable from first of policies bought after 1st April 2023. So if today you're paying 8, 10, 12 lakh rupees of life insurance, then you're absolutely fine. Your maturity will be tax-free under 1010D. So there is nothing that you need to worry about. From 1st April 2023, this is aggregate. So if you cannot buy 4 lakh ki do policy, that will still become taxable. ठीक है, but this is only applicable to investment plans. So when I talk about a legacy planning product, that doesn't get covered because there the money is being paid to you as a claim. So the claims still remain this thing. So policies purchased till 31st March 23 will have a tax-free maturity, and that's why everybody who can wants to buy a life insurance plan now. And it truly does make sense because there are some great products that are available this thing, and I have already covered that death benefit will not be taxable. It will continue to be tax free. So as I was explaining to you why tax free guaranteed return plan, this is the basically showing you the FD interest rates. So they used to be 10%, 9%, and then there was years in 90s when they went up to 13%, 12%, 11%. Then early 2000 they came down to 6, 5, 6%. And then under the Congress government, they went up to 8%, 7%. They didn't go beyond that. And then they were back down to 5% during the pandemic, and now they are up to 6, 7%. So what you see that average return for the last 10 years for an FD is 6.6% pre-tax. So if you look at a post-tax return, it's only 4.62. So which is not a great return and after tax because you're not even beating inflation. So you need to find investments like in mutual funds and others which are better than this. So if I was to why do I feel that interest rates in India will be lower? I am giving you an example of Japan, Croatia, China, where interests are less than 1%. Australia, Kuwait, Norway, Maldives, Sweden, Cambodia is 1 or 2%, and 2 to 3% in United Kingdom and others. So the whole concept is that India wants to become a manufacturing economy. Manufacturing is all about investing in your business. So you have to set up capital, you have to set up a plant, which requires a lot of investment. If we are borrowing at 9-10% and another China, they are borrowing at 1%, then they can set up a much better industry than we can set up. Okay, so if India wants to become an industrial powerhouse, the government will have to reduce the interest rates. So my belief is that in long-term interest rates will have to be brought down to 3 to 5%. If India truly wants to be a manufacturing superpower in the world, otherwise it will remain a services economy. So if the interest rates are 3 to 5% and you have these products which are giving you 7% tax-free IRRs, then you are doing amazingly well. And as I explained to you, you'll ask me why not mutual funds? Because when the interest rates come down to 3%, the mutual funds which have been delivering 10 to 14% will also start delivering lesser. Because that's the whole cycle where the economy works. So it's same things can be seen in the GSEC trends over the past 25 years. From a high of 12.5%, today it's an average of 7.5%. So GSECs are the core the backing of any debt mutual fund. So if you say that if they are investing at 7.5%, they cannot deliver more than 6.5% to you. And then after taxes, if you're investing less than 3 years, you have to pay 30% tax. Above 3 years, you have to pay as per the indexation. you will end up getting about a 5.5-6% type of a return. Another important thing, as I was telling you, that life expectancy is increasing. So Hong Kong is already 85 years, Japan is 85, Macau is 84 years, Switzerland is 84, 84, India is 70 years at the moment. But that's also because of the poverty line. A lot of people below the poverty line. If you look at people who are above the poverty line, this is already around 80. And it is a life expectancy in India is expected to be 82 years by 2035. So 82 years would mean 92 years for the people in the mass affluent and the HNI category. So today, most of you have bought term insurance plans till the age of 65, 70, 75. Now, those are actual missells. So please get those plans reviewed. Bajaj Capital offers that service, or get those plans reviewed and go for a term insurance plan that gives you the coverage till the age of 99, 100, 120, or bare minimum if you want to save on the cost is 85 years. Do not buy a term insurance less than 85. And then even when your children are older, they don't need this. Use this as legacy planning, the money you want to leave for your next generation, so that you can take advantage of your own money and you can enjoy it to the best of it. So I'm also giving you some comparison. The public provident fund is 7%. It is tax free. Fixed deposit is 7.5%, but it is taxable. National savings certificates are 6.8, but they are taxable. So, and when we talk about tax-free guaranteed return plans, the yield depends on the illustration. It depends on the age. So don't go by, like if I'm saying 6.97, it is 6.97. Please look at your illustration. Ask your advisor or Bajaj Capital, whoever you're working with, to calculate an IRR for your investment. Okay, IRR means that internal rate of return. That's the actual return this will deliver after the cost of GST, after the cost of life insurance and everything. Okay, and today, after the cost of life insurance, the best product can give you anything between 6.75 to 6.97. Returns are tax-free under 1010D till 31st of March. And there is no limit. You can buy any amount. Protection of a life cover of minimum 10 times of the premium paid. So you suppose you are paying a 10 lakh rupee premium, you'll get a 1 crore rupees of free life cover along with this product. There are three types of guaranteed return plans. So the first type of guaranteed return plans are the lump sum plans. These are the plans which give you a lump sum amount. So this is if you want to save for some event like your own retirement, buying a house, your children's marriage, or your children's education. Then you buy these products which give you a lump sum. The typical IRR is up to 6.25. Then the second type of guaranteed returns plan are long-term income solutions with a tax-free IRR of up to 6.97%. This is a very interesting plan, and this is something I have also bought for my own children, that I pay 50,000 rupees for them every month. And then, they will get 50,000 rupees every month for the next 30 years from my side. And then they get the corpus back with some bonus. The return is around 6.7, 6.8%. But it's just a concept that, they'll get to remember me, and they'll get something from their father every month. So the need it can be for me, it can be for creating something for my children. We have also sold it to a lot of celebrities who have a very high income today, but they don't have the guarantee of that income. They are cash rich today, they buy this product. And then the third product is an immediate income solution with tax-free IRR. This is basically an alternative to an SWP created by insurance companies. Now, this is a product which a lot of people don't know about. If you ask 99% of the insurance agents also won't know about these products. These are again brilliant products for a person who today is sitting on a huge lump sum of money and wants the return which are immediate, and he wants his return to be guaranteed. Now, somebody had asked this question between the systematic withdrawal plans and this product. Because SWP is my favorite because it gives you the flexibility. But there are no guaranteed returns. It is subject to market risk. So you need to make a combination of both. I will rather buy this product than an annuity product because annuity product is taxable and this is tax free. So for a person who's in a higher income bracket, this is tax free and this is a better product to have. So giving you just some example to explain what the products that we were talking about, like a guaranteed income goal is a product. You pay 10 lakh rupees per annum for 8 years, then you wait for 12 years, and then you will get about 2.197 to about 2.1 crore rupees. Okay, there's another product which is you pay 10 lakh rupees for 5 years, wait for 10 years and get 1 crore rupees. Okay, and the returns IRRs are given as 6.25, 6.13. So please take a very informed, calculated decisions. No product is bad per se in lump sum. But in every industry, there'll be good products, there'll be bad products. So when I talk about the regular income product, so I want to show you an example. You pay 10 lakh rupees for 10 years, then wait for 5 years. Then income period for the next 30 years, you get a 1.3 lakh rupees per annum. And on maturity, you get your 1 crore that you have paid as back. So you're getting a 6.97% sort of a return. And if the same product you took for 5 years with a 5-year waiting, the return would be 5.68%. So this is the most interesting product. These are the products which are started recently, which talk about giving an immediate income. These are people who have high income, this thing. So, again, is that you want to take care of kids and you want to put some corpus, you have some money lying, you've sold a house. So this is a person who invests 10 lakh rupees. He pays for 7 years. Income period is 40 years. So he gets 25,000 rupees per month from right now for the rest of his life for the next 40 years. Plus he's getting 1 crore rupees almost maturity, 1 crore rupees of life cover. The IRR is 5.41%. So guys, again, as I'm trying to explain to you, the IRRs are different for different products, different ages, different. So the point is that please look at your product, your illustration, and what is the right IRR for you. So there's another concept is that employer-employee. So now people ask this, that look, do I have now I want to buy a 10 lakh rupee cover, but I don't pay myself enough. I'm a businessman. But can I pay the premium from my company? Yes, you can. There are two ways to do it. One is where you buy the policy in the company name. In that case, it will be taxable and you can assign the policy to you later. The second, but it doesn't get added to your income at the moment. The second thing is that you pay the premium on behalf of yourself. The policy is in your name, so you pay tax on the fringe benefit tax on your premium today, but the policy remains tax free. So you can choose either of these two options. This is what I have just explained to you. So this is the assignment. This is the tax implications that I've explained to you. So guys, this is the typical thing I wanted to tell you about, and I wanted to cover this because I think for those who can afford to buy it, definitely buying a above 5 lakh plan is very, very important before 31st March, because there are some fantastic product out there. Like I have personally bought the 6.97% tax free return product for my children. I bought it for myself also. So I am telling you to buy a thing which I have done for myself. So if you today have the money, please do buy it. It's an amazing product for those who don't want to take a risk. So guys, I'll take some questions. So please, if you have any questions, please feel free to ask those questions. Vinod is saying, what about mutual funds? I'm investing 10,000 rupees per month for the last 8 years. Vinod, excellent. Please keep doing that. SIPs are one of the best products, but also keep looking at that you're selecting the right mutual fund products, because they are mutual fund products like my own portfolio. Some products have over the last 15 years have only given me a 6% IRR, whereas other products have given me a 17% IRR. So you have to make sure you're invested in the right fund, the right fund manager. So every fund, every product is not good. So you must invest with a distributor or an IFA or a company like Bajaj Capital who has got good research, who are able to tell you that these are the products which are likely to outperform for the next 5 to 10 years. Yeah. So now the question is that, look, I want to buy a 5 lakh policy or a 6 lakh policy, but I don't have a 6 lakh lump sum. So can I buy a monthly mode product? Yes. So if you buy a monthly mode of 50,000 or 1 lakh rupees a month, whatever you want to buy before 31st March, then it will be assumed that you have bought a policy before 31st March, and you will be uh, you'll be eligible for tax-free returns. Manmohan is asking this question: what is it better to invest in, bank FD or guaranteed return plan? Manmohan, this is what I was trying to explain. That if you are investing for the long run, you are investing to build an income, you're investing for your children, and you're using debt for that, then it is better to buy a guaranteed return plan because you are getting an assured interest rate. Chances of interest rates increasing beyond this are very low. Chances of interest rates falling down are very high. But so you cannot use bank FD for that. Bank FD is for your emergency money. Rajendra Pandeyji is asking, is 6.6% guaranteed IRR okay, or should I lock in or wait? As I said earlier, Rajendra ji, please lock in, because the chances of interest rates going up are very minimal. Chances of interest rates coming down in the long run are very high. So it's better to lock in. Pandi is asking, what should I consider, short term or long term guaranteed return plans? Pandi, I'll definitely choose long term plans, because the whole concept is that I am guaranteed a 6.6, 6.9% for the next 30, 40 years. So I will always choose a long term plan, because it gives me, and when if I've got a high guaranteed return plan, then I will always have a chance to do a surrender if I ever need a lump sum. There's a LinkedIn user who's asking, do we need to have a life cover till the 80 years? No, as I've said, you need to buy minimum till 85 or till 99 years. So, if unless you don't have any liabilities or any children, then that's a different thing. But if you have liabilities or you want to leave something for your children, then it is better to do that through a insurance plan rather than investment, because tomorrow they may be estate planning. The way the government is going, they're trying to tax everything, especially for affluent and HNI. So tomorrow there's a high likelihood of estate tax where 30-40% of your savings may go to the government after you. So it's better to buy a life insurance if you can. Sanchay Plus falls in which category? Savio is asking. Sanchay Plus is a guaranteed return plan. It's a non-par plan, but it comes with a par option also. So please be very clear that whether you're buying a par or a non-par plan. So they are asking that whether you should invest in equity or buy these plans. Again, it needs to be a combination of both. They are not alternatives to each other. They are a great combination to have. PPF gives you 7%, but PPF interest rates are changing every year and the amount is limited. So I would rather invest in a guaranteed return plan than a PPF, because it's giving me a 10-time life cover also. It's a very good way of incrementing my pension. Suppose I buy a plan which gives me 1 lakh rupees per month, then at least I'm sure that, look, 1 lakh रुपए तो आएगा ही, या 2 lakh रुपए तो आएगा ही per month, and then I can do other investments and savings beyond that. So you need it's a mixture of everything. It's a combination of all. So I hope, guys, we have been able to answer your questions, and thank you for joining a special edition of FINtastic Talks on Holi. Wishing you all A very, very happy Holi and the festival of colors. May your life be joyful, prosperous, and wishing you all the best. Thank you for joining us today. So, guys, I think we have. So, I